Hello and welcome everybody to another episode of SF Live. Thank you so much for tuning in. Thank you for joining us here. And we have a special guest on the program today. It's Adrian Day from Adrian Day Asset Management. Adrian is a staple in the mining sector. He's got great commentary on what is happening in the world, especially the macro aspects of the US dollar, what is happening with the Fed. We're going to have a discussion about inflation and what the market is up to. Like the market is trading at very high multiples, and we're wondering, and I'm wondering, what will break the camel's back? What's going to be that final piece of straw that is going to break the camel's back? And what I'm always curious about when we talk about doom and gloom scenarios, like what will be the outcome? What do you think the next step is as well? What could the new world order look like? For lack of a better term, I hate it because not too much of a conspiracy theorist, but of course we got to think ahead. We got to think finance as well. And I really want to funnel it down with Adrian from the macro through the micro to the Adrian Day way. We'll talk about that, and I'll have him on in just a second. So please follow us on YouTube, follow us on Twitter, hit that like and subscribe button, and leave a comment. Smashing that like button will help us get more visibility, more investors, and more like-minded investors like yourself will see the video pop up on YouTube on the home screen and will watch it and share enthusiasm with you as well. Now, enough of me. Let me introduce my guest. And Adrian, it's great to welcome you back on SF Live. Good to see you again.
Well, thank you very much for having me, Kai. And hope you're not too cold over there in Germany.
Not yet. Let's talk in 3 months. I'll bring you back on and we can have that discussion, right? I'm personally a little worried. I might buy a fireball or so for the backyard, just in case.
Okay.
Now, you started it off, like, great comment there on what's happening on the macro side. There's so many factors going in. I'm personally losing a little bit of track. There's so many small and bigger things influencing the world markets right now. Let's try to make sense of it maybe together. But it feels like the overwhelming or majority of commentary, and we're coming, by the way, we're coming from a gold and silver angle, precious metals angle, is obviously the Fed and the US dollar. We had the Fed or Jerome Powell speak on Friday after the Jackson Hole meeting, where there quite a few central bank presidents were in Jackson Hole, Wyoming, discussing what is next. What do you think will happen next, Adrian? Like, what are the next steps here?
What will happen next? I think what Jerome Powell said in Jackson Hole was not really a surprise. It had been well telegraphed, and the market sort of knew that he was going to sound tough. He had to sound tough because of some of his recent comments, which the market took as being, softening up a bit. So he had to sound tough. That's not a surprise. I'm a little bit amused at all of these Fed spokesmen and frankly ECB spokesmen as well, who it's like they've suddenly found religion and they're thumping the table for how we have to control inflation, and inflation is so terrible, and so on and so forth. It's a bit like a reformed drunk. The question is, where were they a year ago and more? Anyway, but the question was, what next? I think, my own sense, I disagree with some of my friends in the business. I think the Fed is going to, and I've said this all year, I think the Fed is going to try to raise rates for a lot longer than most people think. Because when you look back at 2018, 2015, 2013, and they say, oh, the Fed just pivots as soon as the stock market, has a hiccup. There wasn't any inflation back then, or there was no inflation to talk about. When you and I talk about inflation, we're going to use it as is commonly referred to, with consumer prices going up. I think, it's important that people realize that inflation is actually excess money creation. We've got inflation, whether we like it or not. The Fed has created excess money. When you look at the balance sheet at 9 trillion, up from 750 billion 12 years ago, the economy hasn't grown 12-fold in that period of time. So there's been gross excess money creation. So I think the Fed is going to try and stick with it a little longer than some people anticipate. But there's two things coming up. Well, there's a couple of things that are going to happen. One is the Fed has said it's going to start QT, quantitative tightening, reducing the size of its balance sheet at 95 billion a month, starting later this week, starting in September. They had a plan to do whatever it was, half of that for the last 3 months, which they somehow miraculously have failed to do. One has to ask the question, if they haven't been able to do, 40 billion or 37 billion, whatever it is a month for 3 months, do they really think they're going to do 95 billion a month starting later this week? It was interesting to me. I don't know if I'm reading too much into it, but in Powell's 8-minute speech, which is sort of ridiculous, really, 8 minutes, but in his 8-minute speech, he didn't mention the balance sheet once. He hammered on about interest rates, we're going to do it, people don't believe us, that kind of thing, but he didn't mention the balance sheet once. And I'll stop here. I think withdrawing that amount of money from the economy, because that's what we're talking about, withdrawing that amount of money from the economy every month, that's going to be much more significant than raising interest rates by 50 basis points or 75 basis points. That's going to have a very damaging effect on the economy. And for the last 6 months, or really for the last year, ordinary people have been concerned with inflation, with prices going up. That's what all the congressmen have been told. And Biden, President Biden told Powell, hey, get inflation down. At some point, and Powell doesn't care too much about the stock market or asset prices, but at some point, the economy is going to get so bad, unemployment's going to go up, and unemployment is going to be a bigger issue for many people than rising prices. And then I think the message will change a little bit.
I should have taken those because I got a couple follow-up points and questions here. Let's start with the Fed and the Fed fund rate as well. Do you think Jerome Powell will pull a Paul Volcker? Do you think, like, based on the tone, it sounds very aggressive, and the market already expects 75 a basis point hike? Do you expect it will be more drastic than that, or like when you say it's going to be longer rate hike cycle? Do you think he can shorten it by going, well, let's raise by 200 basis points, and I'm being facetious
Oh, I
here,
don't think
obviously.
I don't think that's going to happen. I suspect it'll be 75, which is what the market's expecting, and that's what Jerome Powell more or less said. It's interesting. Is he a Paul Volcker, or is he going to do a Paul Volcker? There's a couple of significant differences between now and then. Number one, of course, is that there's so much more debt in the economy today. The debt to GDP is 4 times what it was back in 1980 in the US. And so raising interest rates has a much more damaging impact on people, households, corporations, and the government's ability to service debt. So that's one huge difference. The other thing that people don't really look at is, Jimmy Carter, for all his failings as a president, he did appoint Volcker, and we knew what Volcker was going to do. And then Reagan came in 1980. Ronald Reagan came in 1980 and supported Volcker in deliberately, when I say deliberately pushing for a recession, in raising rates, knowing full well it would lead to a recession. Will Biden have Jerome Powell's back if the economy goes into a 1980 style recession? I'm not sure, but he will. There'll be a lot of criticism and pushback. And you're already seeing that now from like Senator Elizabeth Warren, who, for a college professor, is one of the more ignorant people on economics in the Senate, but that's a pretty low bar, I guess. So that's
really, I don't hear much from. Sorry for jumping in there, but I don't hear much from Biden on that topic at all. Like, and I read the business and financial news daily. There's not a lot of commentary from the U.S. president.
There isn't at the moment. I mean, what Biden did a few months ago was I don't know if it was clever. He subtly told Powell, we support the independence of the Fed, So this is on you, Powell. Inflation's your number one job, but we're not going to tell you what to do because we support the independence of the Fed, which is kind of clever. Now, there's midterm elections coming up. I'm not a conspiracy theorist, by the way, like you. But there's a midterm election coming up, and so there's been a lot of pressure on Powell to bring prices down if he can before the midterm elections. But I think we're going to see, if we're not already in a recession, that's a different debate, but it's going to be clear to everyone that we are in a serious recession by the end of the year. And I think President Biden and the Democrats will then be able to blame that on the Republicans in Congress who don't allow them to spend more money. Spending more money to stop inflation is one of the more perverse ideas out of Congress. And again, that's a pretty low bar as well.
So many follow-up questions here, like student loan forgiveness as well, or student debt, or student loan debt forgiveness as well is another topic that is being hailed as inflation, or to bring down inflation as well. I'm not sure how that theory really works because you're pretty much pumping money into the system and giving money to people that didn't have any or definitely had debt before and now they don't have any more. How does that fit in? Is that just an election promise?
Well, Biden and the administration, they're doing as much as they possibly can without having to go to Congress. In the US, there's these things called executive orders. I don't know how that works in Germany, but they've grown and grown and grown over the last several decades to where presidents can do an awful lot of things without going to Congress. Biden's justification of this is actually a law that was passed after 9/11, and he's which gave the president power to forgive certain debts of the U.S. government. That's a bit of a stretch, frankly. I think if it were challenged in court, I'm not a lawyer, but if it were challenged in court, I suspect they would lose on that. But anyway, the point is they're trying to spend as much money as possible to lower income people mostly in order to, calm, as it were, that base.
Follow up to the previous comment you made, and it's taking the money out of the system, the $98 billion every month that is about to start pretty much in a couple of days. Where do you think you'll see that, let's call it QT, the tightening first? Like, where do you see the first, let's say, cracks in the system? Where do you think money will be tight first?
Well, certainly, housing and mortgages, we're already seeing that. But, the Fed's balance sheet consists entirely of treasuries and mortgage-backed securities, as you know. So they're going to have to, if they do 95 billion a month, they're going to have to sell some of their mortgage-backed securities. At the moment, all they've sold is treasuries. That's all they've sold, and the mortgage-backed securities have stayed pretty much flat in the last 3 months since they said they were starting this. So that's definitely going to be one place. I think what you're going to see is a combination, of increasing interest rates and withdrawing liquidity. Warren Buffett has a wonderful saying that you'll see we'll see who's been swimming naked when the tide goes out. And we don't really know where we're going to see those difficulties. But clearly, if they keep on this track for the next 12 months, something somewhere is going to break. It might be a major bank, although the banks generally are in pretty good condition right now. I think a lot of small businesses will be seriously affected because small businesses have been able to get a lot of easy money loans as well over the last few years. And as you have those low interest loans, typically you've spent them. You haven't just got a low interest loan and stuck it in the bank. So when rates go up, oh well, that's the end of that. I mean, you've spent it. So when rates go up and your debt matures, you're going to have to renew it at a higher interest rate. So I think we're going to see it across the economy, frankly.
Yeah, no, good point. I think mortgage and car loans. I'm really curious what car loans are going to do, because apparently that's a very fickle market, and credit card debt as well. There's so much credit card debt, especially with the higher energy costs right now.
Well, that's why I mentioned the banks, because credit card debt has gone up. One of the weeks in April, it was the largest increase, in history. But what we've seen this year, by and large, is retail spending has stayed more or less flat. And some people have been surprised it hasn't gone down with the weakening economy, but it stayed flat. Well, when prices have gone up by 10% and retail sales are flat, that means people are buying less volume. They're buying fewer things, number one. Number two is a lot of people don't have the cash to buy and they're running up their credit cards. So at some point, and it's different for different people, of course, but over the next few months, we're going to start seeing people who've run up their credit cards, and now what? They don't have any more credit available. So those retail sales are going to have to come down at that point.
I think we've seen Walmart and Target already start to reduce their inventories because they overstocked, expecting higher
Target
demand.
in particular overstocked. Yeah, Walmart had a very, very interesting comment. I don't know if you heard this on their last conference call, which was their sales had held up, but they said they had noticed a change in the demographic of their customer, and they were getting more middle class and even upper middle class shoppers than they ever had before. And so that just is an illustration of the fact that people are still spending the same amount of money, but they're going down market. They're buying a generic cereal instead of Kellogg's cereal. They're giving up. They're giving up some of their things. Maybe they're buying chicken instead of filet or whatever. But that was a very interesting comment. The Walmart said they're noticing higher income people shopping in the stores.
Maybe last question on the macro before we start talking more gold and silver as well is you mentioned unemployment needs to tick up quite a bit, and that's a number or statistic, especially in the U.S., that's puzzling me quite a bit. The creation of new jobs. Like all of a sudden we had one job report with half a million new jobs created, which was completely out of the ordinary. But also, like, wherever you walk around, it's the same thing here in Germany, actually. There's a lot of, like, we're looking for people signs. Like, we're looking to hire. So that seems like a controversial statement, but it feels like the unemployment or the job market needs to do a complete 180 to collapse right now. And how does that factor in? And what do you see it maybe triggering that?
The
recession, yes, but...
sorry.
Yeah, go ahead. Just trying to figure out what the trigger is.
Very, very confusing at the moment. You've got a lot of factors. So yes, you have a very low unemployment rate, but you also have a reduction. Excuse me. You have a reduction in the job pool. So people are taking themselves out of the job pool. So the unemployment rate doesn't measure people that are no longer looking for a job. You've also got a lot of government jobs, and you've still got quite a lot of part-time jobs, more than normal. But I think the most significant thing, Kai, that a lot of people don't realize when they look at the jobs of the unemployment number is that unemployment is always at its lowest right as a recession begins. Right as the recession begins, unemployment is at its highest. Lowest. Unemployment is at its lowest. And you've seen that all the way back to the 1950s. Every single recession we've had in the States, the unemployment rate has been at its lowest before that. So I don't take too much credence from, I don't put too much onto a low unemployment rate. And if I may, I know we want to get off the macro, but to me, this is a perfect example of where the Federal Reserve, and I can only speak to the Fed, not to the ECB at this point, where they get it wrong. Jerome Powell last month said the jobs market in the United States is very strong. And you had Janet Yellen, Treasury Secretary, repeat that, and Biden has hailed that as well as vindication of his policies. The problem is that the Fed is looking backwards. So this Fed says we're very data dependent. We will look at the incoming data and that will tell us what we need to do. Well, by its nature, when you look at incoming data, you're looking at something that's already happened. They're not looking at leading indicators. They're looking at reports on the economy. So when you look at the unemployment rate for July, we're now at the end of August. We're looking at something that's a month to 2 months old already. What they need to be looking at is the labor participation rate. That is the number of people in the job pool, which has gone down again last month. And then they need to, frankly, they've got 400 PhDs in economics in their headquarters in Washington, 400 PhDs. They need to tell a couple of those to just sit on conference calls, and whether it's AT&T, Amazon, Starbucks, across the board, these companies are saying we've got a hiring freeze. Some of them are even saying we're laying off workers. That tells you what's going to happen. The unemployment rate tells you what has happened. So yeah, I think if anything, the low unemployment rate is a forward-looking indicator of a recession.
Okay, no, good point. And last question, yes or no answer. Are we in a recession, Adrian?
Yes.
Okay, perfect. All right. We don't need to discuss definitions because websites change and definitions change. So we don't need to talk about that. I think everybody gets a basic understanding of a recession when the GDP is down a couple of quarters in a row. I think we are in a recession. Let's talk gold, silver for a minute. As I said, we're trying to frame everything a bit of a gold, silver mindset. How happy are you with the gold price right now? And it feels like it's hanging in there.
Yeah, I'm not unhappy with the gold price as a lot of people are. If you look at gold this year, for example, it's down 5% this year as we record this. The dollar is up around 14%. So against the dollar, given that headwind from the strong dollar, gold is actually holding up quite well, in my view. And gold has certainly declined far less than virtually every other asset price. Stocks, US and global, housing, Bitcoin, you name it. Most other assets have gone down more than gold. So I'm not unhappy. I'm not overly unhappy with what gold is doing. The gold stocks is a different matter. They have disappointed me a lot, frankly. They have fallen during a decline, from March to June. They fell a little bit more than the broad market, frankly, and they had not participated in the rally. So they've been a big disappointment, and we can talk about that if you want, but
yeah, no, we will definitely because it comes down to the positioning as well and sort of what your strategy is now. I mentioned to you, I had lunch with a family office / asset manager today, just now before recording here a couple hours ago. And he told me he's been getting a lot of inbound calls from families, high net worth individuals, like farmers that own farms, like some of his clients that ask him, how can I protect my wealth from inflation? I have some cash sitting in the bank. What do I do now? And I think it sort of brings us to your portfolio strategy as well. What are you offering, and how are you sort of handling this situation?
Yeah, no, good point. And we're getting the same kind of questions, but overlaying on that is a concern about the overall market. So you've got two things: protecting from assets, but also concern about a recession and the overall market. Oh gosh, there's a lot to unpack there. So let me, first of all, we are really in a stagflationary period already, a stagnant economy with high inflation. I think that's going to become more more clear, more obvious, if you like, over the next year or two. The economy is going to be stagnant at best, but I think heading into a recession. But inflation, in the US, if it comes down from 9.5% to 6% or 5%, that's still high inflation. Now, in stagflationary periods of the past, going back to the early 1960s, typically gold has been the top performing asset. Oil and gas has been second. Other commodities have been third, and the commodity stocks have also tended to do very, very well, particularly towards the end of the, before the end of the run, until inflation is finally brought under control. On the other, the only other sort of broad asset class in which we're interested but does well are the smaller equity markets. Smaller equity markets tend to do well in that environment, but particularly if the dollar's declining. So they haven't sort of shown their stuff yet, if you like, because the dollar, of course, has been very, very strong. So how we're positioning with both of those objectives in mind, one is to protect inflation, but the other one is also to be cognizant of a stock market. The US stock market and major global markets are still very, very expensive. And I think it's important that everybody realizes that, because we tend to look just at the recent past and we say, oh, we've had a bit of a correction. We've taken the air out of it. There's some good bargains. Well, the S&P, as we talk, is trading at 19.5 times earnings. Other than January this year and the dot-com bubble, this is the highest multiple in history. Stocks are not cheap at the moment in the US. And, so I think we've entered a bear market. You always get rallies in bear markets. The first rally is normally the strongest, 12 to 15%. We've seen that. We've seen more than 15%, in fact. And that rally is clearly over. And I think we're going into a second leg down. So we are very, very cautious. We're global managers, by the way, not just gold managers. We're very, very cautious on buying global equities right now, other than the very best quality global defensive stocks, like Nestle, for example.
Oh, funny, that was the name he mentioned as well, because they pay a good dividend. It just fits everybody's portfolio.
Yeah. Well, the truth is, if the US market drops 25% from here, Nestle is going to go down as well, but it is definitely going to go. Past performance is not.
No, there was what are they called? Moat stocks.
Yeah, it's
To a degree,
it's got a good moat, and it's going to hold up. If history's a guide, it's going to hold up better than other stocks. So we're buying a few global equities, but we are very, very underweight major global markets. We're looking in smaller markets, finding more in Singapore and Hong Kong than we are in, say, Latin America at the moment. But being pretty cautious there as well. But there are some incredibly cheap stocks in those markets. So that's number one. We're always, of course, on the lookout for special situations, stocks that miss their earnings by a penny, and stock goes down 20%. But it's always difficult. If you're in a bear market, it's always difficult trying to sort of, get a few cents on a rally. That's always difficult. So that's number one. The second thing we're doing is looking at high dividend payers that we think will be consistent dividend payers and have the ability to increase their dividends, because that's important in a period of increasing interest rates. You need something, you don't want a bond, obviously, where the yield is static. You want something which has the ability to increase its dividend. And we're buying a few of those, and there's some very good buys. I can talk about specifics if you want. So we're buying those both in the US and also globally. And then lastly, on the gold and silver, we're focusing more on the senior stocks right now than the juniors, just for two reasons. One is the senior stocks, the senior stocks will be the first to move when gold recovers, and the more certain to move. By that, I mean that if gold goes to $1,950 an ounce, I can almost guarantee you, I can't say that the SEC won't like it. I'll bet you any amount of money you want. But if you buy Agnico and Gold Fields and Barrick and Newmont, I will bet you those stocks will be up. On the other hand, gold goes to 1950 and Consolidated Moose Pasture may or may not be up. That's not a real company, of course. So we're sticking with the seniors at the moment, A, because they're the more certain to go up and the first to move, but secondly, because they're just so darn cheap right now. You look at a stock like Barrick, the second largest gold miner in the world, it's got net cash positive, which itself is astonishing for a miner in a capital intensive industry. You expect them to have debt. Barrick has net cash on its balance sheet. Its yield is 4.7%, which is what, twice the S&P? No, it's nearly 3 times the S&P. And yet the stock is trading at virtually the lowest price to cash flow multiple in its history.
Yeah.
In its history. That just doesn't make sense because we're all concerned about costs going up and gold has dropped and so on. But if your cash costs are, not your cash costs, if your all-in costs are $1,200 and gold is at $1,750, you've got a pretty darn good margin, right? Now, obviously, you have to look at what's going to happen ahead. But right now, they're making money, and they're making the gold stocks, and they're making a lot of money. So that's what we're focusing. We do like the royalty companies, the major both the large ones and the small ones, because they have leverage to the gold price, which is another issue perhaps. They do have leverage to the gold price. They don't have the risk of being a miner, but most importantly of all, they are far less exposed to cost pressures and inflation than miners are. And in fact, we saw that in the second quarter reports from all the major companies. All of them, Barrick, Newmont, Yamana, Kinross, they all had problems with costs. The only one that didn't was Agnico for particular reasons due to the merger they did. But all of the miners had cost problems, Pan American and so on. The royalty companies were all reported, good revenue and earnings. And for Franco, their costs actually declined. So, they're much less exposed to inflation.
No, fantastic. Yeah, definitely. And Franco is trading at insane valuations as well. I think it dropped 50% and is a screaming buy right now, in my opinion. But what do I know? I'm a gold, silver, somewhat bug. So, and my portfolio is deep in the red. So please don't follow my advice at all. Adrian, it was a fantastic conversation. We have to end it here at this point. But you have a newsletter on the website as well. Lots of good information on your website. I've been on it all day this morning preparing for our conversation. Adrian Day, I'm just looking at the website. What was the domain? Here we go, adriandayassetmanagement.com.
Right.
Please go visit it. Adrian, it was a great pleasure having you on. Thanks for your time.
Well, thank you very much, Kine. Let's do it again. I'd love to.
Oh, I'd love to. Yeah, we can talk in the winter here and how I'm freezing my butt off here in Frankfurt.
Okay.
So, fantastic. Awesome. Everybody else, thank you so much for tuning in. I really enjoyed the conversation here with Adrian Day from Adrian Day Asset Management. Really clear and concise opinion on what is happening in the markets, where he sees some value also primarily in the gold and silver space. Gold space we mostly talked about, but it makes sense. And if you enjoyed the conversation, leave a comment, leave a like, smash that subscribe button as well. We much appreciate it. And we'll be back with lots more good content and really appreciate your time. Thank you so much.